All right, welcome to Iron Financial. This is the only place where we forge a stronger portfolio by cutting right through the market's weakness. Today, we're tackling a titan, BlackRock. Now, they just dropped what, on the surface, looks like a monster Q1 earnings report. I mean, one of the best in their entire history. But here's the thing, the market isn't buying it. The stock is getting hammered. And that right there, that's a massive contradiction. It's a paradox sitting right at the heart of the financial world. So today, we're here to crack it wide open. Okay, let's get into it.
This is it. This is the whole ball game right here. The central question we have to answer. You have a nearly $14 trillion behemoth putting up these incredible blowout numbers, but the stock is falling. Now that tells you one of two things. As the lead analyst, my job is to dig into the numbers, and believe me, they look solid as a rock. But that's why we have our market skeptic here, to ask the questions that need asking.
Exactly. And my question is pretty simple. Is the market completely missing the story here, or are these incredible headline numbers just hiding a serious structural weakness, a trap? Our job, what we do here at Iron Financial, is to dig through the filings, to stress test these numbers, and to figure out if BlackRock is actually building a fortress for the future, or if we're just looking at a shiny facade with some really dangerous cracks in the foundation.
Okay, so let's start with my case, the bull case. And on the surface, I gotta tell you, this case is built like an absolute fortress. The first quarter numbers are, and I'm not exaggerating, staggering. If you were an investor who just looked at the headlines, you would be buying this stock with both hands, no questions asked. It looks like a simple open and shut case of a company that is just firing on all cylinders. So let's look at the raw power of these numbers and see why this thing looks like it's forged from solid iron. First things first, you always look at the engine of any company, revenue. Year over year, revenue absolutely surged. We're talking about a climb of 27% to hit almost $6.7 billion. Folks, that's not just growth, that is an explosion. For a company of this sheer size to post a 27% top-line expansion in this market environment, well, that's a massive signal of some serious commercial momentum. It's telling you that their platform is just pulling in cash at an accelerating rate. This is what pure strength looks like. In that revenue, it flowed directly down to the bottom line. GAAP net income came in at a huge $2.2 billion. Just let that sink in for a second. A profit of over $2 billion in just 3 months. This isn't just about making a little money. This is about the unbelievable scale of the cash-generating machine that BlackRock has built. This is the kind of profitability that builds empires. I mean, this is the very bedrock of a solid financial structure. Now, let's get down to brass tacks, what Wall Street really cares about. Earnings per share. The adjusted EPS came in at $12.53. Now, the Zacks consensus estimate, what all the so-called experts were predicting, was way down at $11.46. So BlackRock didn't just beat the estimate, they absolutely blew it out of the water by nearly a full dollar. This wasn't some little beat, this was a dominant performance. And get this, it's the 4th straight quarter they've done it. That's not a fluke, that's consistency, that's discipline. So now let's put it all together on one screen, because it's not about just one number, it's the entire picture you're seeing right here. Just look at that year-over-year change column on the right. Revenue up 27%. GAAP net income, it's rocketing up by a massive 46%. But here's the number I want you to really focus on, the crucial last line, adjusted operating margin. It expanded by 130 basis points to 44.5%. What this tells me is that this isn't just a company that's getting bigger, it's a company that's getting better. They are becoming more efficient, more profitable for every single dollar of revenue they bring in. That points to structural strength, not just some one-off good quarter. And look, don't just take my word for it. The man in charge, CEO Larry Fink, he said it himself, and I quote, "BlackRock delivered one of the strongest starts to a year in our history." When a CEO of a company this size makes a statement that bold, and it's backed up by numbers this strong, it's designed to project absolute, unshakable confidence. The message couldn't be clearer. The fortress is stronger than it has ever been. So with a picture this perfect, I have to turn to our skeptic. What in the world could possibly be wrong here? Whoa, hold on a second. This is where I have to step in. Before we go and declare victory and crown BlackRock the king of finance, let's actually do our job and stress test this so-called fortress. Because the market, the collective wisdom of millions of investors, isn't buying Larry Fink's story. And when the market disagrees with a CEO this loudly, you have to ask yourself why. The numbers you just saw, those are the headlines. They're the shiny objects designed to grab your attention. My job is to look underneath all that, to see if there are any cracks in the foundation. And I gotta tell you, I'm seeing a few pretty big ones.
That's the multi-trillion-dollar question, isn't it? Is all this strength real and, more importantly, durable, or is it just a temporary surge that's masking a much deeper issue? See, the whole bull case rests on the idea that these earnings are a sign of unstoppable momentum. So I have to ask our analyst, if the momentum is so incredibly strong, why are we seeing these huge red flags in the single most important metric for any asset manager? The one number that supposedly underpins this entire empire.
And here it is. This is the problem. Just look at these numbers. Assets under management, AUM, the absolute bedrock of BlackRock's business, it actually declined. They ended last quarter with over $14 trillion under their belt. This quarter, they're at $13.99 trillion. Now, they'll tell you they brought in a massive $130 billion in net inflows, which sounds great, but their total pile of assets shrank. That is a huge disconnect. It means that market declines completely wiped out all those new inflows and then some. For a company whose fees are directly tied to AUM, a shrinking asset base is a very, very serious headwind. That's not a small issue. That is a crack in the foundation.
And here's the result. This is what the market is screaming at you, loud and clear. Year to date, BlackRock's stock is down over 4%. At the same time, the S&P 500 is actually up. So this company is dramatically underperforming the very market it's supposed to have mastered. So the question for everyone watching is simple. Why would you own a stock that's losing ground when its earnings report looks this good on the surface? The market is pricing in a problem. It sees that AUM decline and it is punishing the stock for it. The headline earnings beat just isn't enough to hide this crack. You're right to be skeptical. You absolutely are. But you're looking at BlackRock through the wrong lens. You're using an old map. If you honestly believe their earnings are solely dependent on the level of the S&P 500, then you should sell the stock. But you are missing the much bigger picture. You're looking at the old blueprint. The reality is, BlackRock is in the middle of a massive, deliberate strategic pivot. They are rebuilding their entire engine to be less dependent on the whims of the market. They're constructing something new. They're reinforcing the foundation as we speak.
And the core of this new strategy, the thing you have to understand, is what we call fee architecture. This is the crucial point. BlackRock is actively engineering a business model where its earnings are more durable, more resilient. They are building new revenue streams from technology, from private markets, from advisory services that are not directly tied to whether the stock market goes up or down on any given day. It's a fundamental shift from being just a simple asset gatherer to becoming a complex financial technology and services platform. This is the heavy lifting that's happening behind the scenes, away from the headlines.
And this chart right here, this shows you that new architecture taking shape. Look at the breakdown of their revenue. Yeah, okay, base fees are still the lion's share at 81%. No surprise there. But look at the other slices. Technology services, that blue slice, now makes up 8% of their total revenue. And that's a high-margin, sticky, subscription-based business that doesn't care about market volatility. When you add in the green and purple slices for performance and advisory fees, you've got nearly 20% of the company's entire revenue coming from sources that are becoming more and more insulated from market swings. That 20%, that's the future, and it's growing fast.
So let's break down the components of this new engine. Pillar number one is private markets. They pulled in another $9 billion in net inflows just this quarter. And we're not talking about hot money that can just pull out tomorrow. This is sticky, long-term capital. Their major acquisitions of HPS Investment Partners, a huge player in private credit, and Global Infrastructure Partners, or GIP, an absolute giant in infrastructure investment, are the foundation of this push. And the key here, the really important part, is that the fees are tied to committed capital, not fluctuating market prices. This creates a stable, high-margin, recurring revenue stream that acts like a ballast when the market gets stormy. Okay, next, let's look at their bread and butter, iShares and ETFs. Even in their core business, they are re-engineering for strength. They had a record-smashing quarter with $132 billion in net inflows. That's a staggering number. But what's really critical to understand is that they doubled their net new base fees from this business compared to just last year. This shows they are not just winning on volume, they are successfully guiding their clients into higher-margin, more strategic products. Even within their traditional area of strength, they are optimizing for profitability and resilience. And finally, the third pillar. And this is the real game changer, technology. Their tech services revenue grew an incredible 22% year over year. This is all being powered by their Aladdin platform, which is basically the central nervous system for a huge portion of the global investment community. And by acquiring Preqin, a key provider of alternative assets data, they're making this platform even more indispensable, more sticky. This revenue is almost completely uncorrelated with market levels. It's a pure-play tech subscription business embedded inside the world's largest asset manager. This is the buffer. This is what protects the bottom line when AUM takes a temporary hit.
So when you start to put all these different pieces together, the private markets push, the optimized ETFs, and this booming tech business, you're no longer looking at just a simple asset manager. You're looking at a brand new blueprint for a financial services titan, one that is being deliberately designed to be more durable, more profitable, and really built to last through any market cycle. The real question is whether the market actually understands this new blueprint yet.
And you know what? We're not the only ones who see this shift happening. This analysis from investing.com just hits the nail on the head. They state that the argument is that BlackRock has, and I quote, reduced its near-term dependence on market-level AUM to generate earnings growth. That's it. That's the entire thesis in one sentence. The market is punishing the stock for a problem, that AUM volatility, that the company is actively and successfully engineering its way out of.
This revenue waterfall chart, this is straight from their own investor presentation, and it shows the whole strategy in action. Just look at how they build revenue from one year to the next. You see that massive, solid foundation of base fees, but then look at the new blocks they're adding on top: tech services, performance fees, distribution fees. Each one of those is a new, diversified stream of revenue being built on top of that solid foundation. This is not an accident. This is architecture. This is the actual blueprint for a more resilient, stronger structure.
And I want to be clear, this didn't just happen overnight. This timeline shows a very deliberate, methodical execution of a long-term plan. In March of last year, they closed the Preqin deal to bolster their tech. Then in October, they announced the massive GIP deal to go big in infrastructure. Then this past January, they closed HPS to scale up their private credit platform. Each one of these moves is a calculated step in reconstructing the company's core. They are literally buying the components they need to build this new, more durable engine.
Okay, so we've heard both sides of the argument. The bull case, my case, points to a fortress of record earnings and strategic execution. And the skeptic's case points to cracking AUM and a stock that the market simply refuses to reward. And my analysis reframes it all as a company in the middle of a massive strategic rebuild. So it's time for the iron financial verdict. Let's lay it all out on the table, pros and cons.
All right, let's weigh this on the scales. On one side, you have this solid opportunity. What I see is a company building a durable fee architecture that's going to reduce its reliance on the market. We see the proof in that margin expansion up to 44.5% and in 4 straight quarters of beating EPS estimates. This is a proactive, strategic pivot. To me, that's a sign of a very well-run machine.
But let's be real, there is a potential trap here. Integrating these massive acquisitions like GIP and HPS is not going to be easy. There is huge execution risk. And while they're diving headfirst into private credit, we're seeing reports of $10 billion in investor exits from that exact asset class across the wider market. That's a real concern. And despite this new architecture, their nearly $14 trillion in AUM is still very vulnerable if we hit a major market downturn. And the biggest risk of all? The stock's underperformance tells you loud and clear that the market right now does not believe this story. It's a classic value proposition versus a potential value trap.
Which brings us right here to the final critical question. The market clearly sees weakness. The company is telling a story of a strategic rebuild. We've laid out the evidence, we've looked at the numbers, and we've talked about the risks. So, is this new blueprint, this new fee architecture, is it strong enough to be a foundation you can actually build a portfolio on? Or are the cracks I pointed out just too deep to ignore?
Our verdict at Iron Financial is clear. The market is making a mistake. It is pricing BlackRock based on its old blueprint, and it's punishing the company for a temporary dip in AUM. It is failing to see the structural reinforcement that is happening right under the surface. The move into private markets, the continued dominance in ETFs, and the explosive growth of its non-correlated technology business are fundamentally changing the company's DNA. The cracks you see are superficial. The earnings are real, the margin expansion is real, and the strategy is sound. BlackRock is not just a fortress. They are actively forging a new foundation. A foundation of iron, built to withstand the pressure of any market. For us, the current weakness in the stock is not a trap, it's an opportunity.
Quick disclaimer, everything I share is for entertainment and informational purposes only. I'm not a financial advisor, so please do your own research or talk to a professional before making any moves with your money.